Earnings conversation with the management of Dabur. The numbers, the revenue was a shade ahead of estimates. EBITDA was in line on a sharp drop in advertisement and promotion expenses. There were a few line items, though, in that the rural markets lagged the urban markets slightly, I guess for the first time in 4 or 5 quarters. They've also announced an acquisition or consummated an acquisition, as the case may be, of 51% stake in Badshah Masala, with the remainder to be acquired over 5 years. So lots of talking points here for Dabur and for the industry. And Ankush Jain, the CFO of the company, joins us right now for that. Ankush, good having you. Thanks for joining in. And at the outset, to you and your team, a very happy new summer.
Thank you so much, Neeraj. Good afternoon to everyone, and a very happy summer to you and season greetings.
Thank you so much. Much appreciated. So, Ankush, put the quarter into perspective, because while consolidated revenues, you could argue, grew about 6%, there was there was some dichotomy or diversity between domestic and international markets, between urban and rural markets. So what stood out for you?
Okay, while our consolidated revenue grew by almost 6%, and if you look it from a pre-CAGR basis or pre-COVID basis, the 3-year CAGR is approximately 10.5%. So consistently, we have been growing in the double digit over the last 3 years. India business also grew by 7%, but in the base, we had a lot of COVID contextual products, which had gained momentum in the base over the last 2 years. In fact, our healthcare had increased by almost 50% in 2 years. So if I just normalize it, still India business grew by almost 12% on a CAGR this year, and CAGR also 11%. So robust growth, and food has been really stellar in India. It grew by 30%, sorry, foods by 20%, and overall beverages by 30%. Healthcare, though, saw a marginal a decline. But again, from a pre-COVID level, it increased by 10 to 11%. Since, in fact, all our 3 business verticals in India grew by 10% or thereabouts from a 3 years CAGR perspective. Coming back to international also grew in constant currency by 12% or so. However, there was steep currency devaluation in Turkey, which the value of the currency eroded by almost 80% over Y-on-Y basis. And therefore, overall international business grew by 2.5%, and therefore the blended growth at 6%. But having said that, both in India and in international, we continue to gain market shares across categories. In fact, even in India, we gained market shares across 95% of the categories we operate. Even in healthcare, where the categories declined, we gained in Chyawanprash by 120 basis points, in market share, in honey by 40 basis points, juices and nectars by 400 basis points, and even in high competitive categories like hair oils and oral care, the market share gains were visible during the quarter and even sequentially. So, and this is at the backdrop of categories declining, because of inflationary pressures. So we feel that despite this inflationary pressures and rural, as you mentioned in your opening commentary, that rural, lagging behind for industry for almost 6 quarters in a row. And this year also for us, also for the first time in last 4-5 quarters, we are rural also lagged behind urban. But still, at least we were able to gain our market shares, across categories and across geographies. Yeah.
Okay, so that's the larger headlines or highlights, if you will. Let me start with the tough news and then get on to the acquisition and then the good news as well. Not tough news really, but just want your perspective on a couple of things that stood out for me, which I wonder whether things improved there. One, rural, which lagged urban. And 2, as you mentioned, in rupee terms, international grew about 2.5%. So in a world which is increasingly looking not linear, and there is prospects of weaker growth in a bunch of areas the rest of the world, how do you think that market does in Q3 and Q4?
Okay, so I'll break this question into 2 parts. First, obviously, the rural and urban. What we have seen for the industry as a whole, not specifically Dabur, last 4-5 quarters, rural has definitely lagged behind urban. And this has lagged behind, and in fact, it's almost declining by 2 to 3% year on year, last for 4-5 quarters or so. For us as well, and in fact, in this quarter, it has declined by -5%. Industry as a whole know. And most of the growth is only coming as price-led. Coming to Dabur, we historically have fared better in rural, which was also the case, except for this quarter in last previous 3 4 quarters. However, this quarter, as I said, our rural, though it grew, but it grew at a lower pace than urban. And the prime reasons, what we feel is, with the inflation and price increases by most of the organizations and in food especially, the disposable incomes have come down in rural, which is impacting category growth, especially in discretionary spends, in HPC, even in healthcare and so on. So yes, we see this phenomena at least for 1 or 2 quarters more as we speak. But with the revival of near normal monsoon, and with revival of capex by the government, we think that this should help boost consumption, probably from January quarter onwards, and with high probability from April quarter and so on. So we are buoyant about overall, rural growth and also urban growth in next fiscal and thereabouts. Correct.
Okay, so rural starts from FY24. Just word on international markets.
Yeah, now coming back onto your next question on international. While yes, we saw a constant currency of 12%, but in INR 2.5% because of currency devaluation. The growth, came muted, especially in this quarter in bit of MENA, which is Dubai. But having said that, why again, the couple of reasons there as well. The price increases because of inflation over there has been in high teens in MENA region, in Dubai, Africas of the world. The consumers there are not used to so much of price increases, and therefore we saw a bit of consumption drop. But there are green shoots available or seen, particularly with oil prices rising, almost 100 barrels, dollar 100 per barrel. We think that this is positive for the demand environment of MENA region or Dubai region, Saudi Arabia, and so on, because these economies are largely dependent on oil exports and consumption. So it's a matter of time before they also see a revival in consumption. And also in last 1.5 years, or recently, as I would say, post-COVID, a lot of expats had moved out of MENA region. Now we are seeing an influx back. The impact of that should also be seen, in next couple of months or so on. So there are green shoots even in international we see. But yes, currently we are passing through turbulent times because of inflationary pressure primarily.
Okay. Well, seemingly FY24 seems to be the culmination of good times, so to say, and how it starts. So it'll be interesting to see.
Hopefully, yeah, hopefully. And we are banking on that as well. Yeah.
Okay. Yeah. I mean, I actually was referring to how your comments seeming to be pointing towards that. Now, tell me, Ankush, do you reckon that the margin pressure that you've seen, and albeit I think it's been seen in various other companies within the FMCG space as well, but this EBITDA margin pressure, can it get arrested and improved upon in the second half of FY23?
Yeah. First of all, why this EBITDA contraction? This is primarily flowing down from gross margins, which has been driven by unprecedented inflation. At least, just a minute on that. I've never seen, 7-8 quarters of continuous inflation of 10-odd%, which means this quarter on a base of 10%, we again had nearly double-digit inflation, meaning almost 20% inflation in 2 years. On a Y-on-Y basis. So this has put a lot of pressure on margins, and also because of that, plus for us, what has happened is there has been rebalancing in the portfolio. Last year healthcare grew phenomenal, which is high margins, while this year foods is growing exponentially. So there's some bit of margin impact as well, though absolute profits we gain. Going forward, what we see is that though inflation would still be there, not to the levels of 10-odd%, but still around 6 to 7%, which also by any standards is very high, on a base of 10-12%. So while there will be a moderation in inflation, but it will still remain above the permissible limits of 6% by the MPC committee. And therefore we see that though there will be some margin pressures, but the contraction in margin may not be as steep as was seen, at least in gross margin levels. Coming to EBITDA margins, EBITDA margins is a function of many other things. Not only gross margins, but how do you play your advertisement? How do you do your infrastructure? Do you hold back on your discretionary spend or your other, things which can be deferred? While we feel that the steep decline in contraction in gross margins will almost reduce by half or so thereabouts, but EBITDA margin we still have to play because part of it we might have to invest back into advertisement because we had to prune it, substantially over last 2-3 quarters. So we still are contemplating on our strategy, but our intent would be to plow back, any gains in gross margins if we have from next fiscal or so, to plow back them in the media investments to generate demand back,
Sure.
and so therefore to play for the future rather than very short term or short quarter centric approach. So
Got
that
it.
would be the theme, especially once inflation cools, I think,
So
Yeah.
you're saying that from 45 half odd, which is what I believe the gross margins came down to, right? You will I mean, the company can probably show about a 43.5% gross margins at the worst. I mean, and that will get arrested at around those levels.
Yeah, so maybe I'll rearticulate it in a different way. See, every quarter the margins are different. Why?
Yeah.
Because of the product portfolio. So what I'm saying is that if the contraction in margins was to the tune of 350 odd bips in this quarter, the contraction will reduce to half or there.
Okay, fine.
Yeah, because the product portfolio plays a lot of things, because of seasonality of certain of our products.
Okay, but console gross margins currently were 45 half. So in that sense,
yeah,
right, 43 half or thereabouts. Okay, right? Is that correct?
No, sorry, I didn't get your exact number. No, why you're referring to?
So, I thought the 350 basis points YOY decline in gross margins led the gross margins down to a level of 45.4%.
Yeah, correct.
Right. So if there is a decline of 175 basis points at the worst, your gross margins go down to what? 43 half or thereabouts?
I know you can't see that way, right?
Okay.
What you have to see is our margins in this quarter were 45% of thereabouts. It will improve sequentially.
Okay.
Because Q3 is relatively higher margins.
Okay.
Because of higher saliency of healthcare. What I'm saying is the contraction of 350 bps which you saw Y on Y will reduce.
Got it. Okay. Fair call. Fair point. Got it. Okay. Now, so we've spoken growth, we've spoken margins. Let's speak about acquisitions or acquisition, the 51% stake. Now, it's a wide category, but it's not necessarily a pan-India category because in a bunch of markets, the regional players rule the roost. Tell us about this. Tell us about why 51% now and the balance over the period of 5 years. And what do you hope to achieve via this one? Because I think you said in the current year, there might not be EPS accretive or maybe marginally, and it starts meaningfully contributing FY24 onwards.
Yeah. So first of all, about the regional, by this acquisition, it has always been our strategic intent to grow our foods business and to grow it to a scalable level of 500 crores or so. Currently, we operate our foods at around 100 crores or thereabouts. So this will give us entry into a very big market. This market size of this spices, branded spices, is alone 25,000 crores. That's a big number. And with a lot of regional players, as you say, and regional leaders, what we feel is though this company, currently the acquisition we have done, Badshah, is presence in West and part of southern markets, adjacent markets. What we feel is that with the Dabur, and this partnership, we will be able to leverage synergies and unlock future synergies in a much, much better way, in a combined way, because it brings, Dabur distribution network. It brings our infrastructure capabilities, plus the knowledge and learnings of the current promoters. So I think that partnership is very important. We think it can scale up not only in the core markets where Badshah is currently operating. We can go deeper into rural markets with our distribution strength and fortify our presence in their core markets as well. Once we establish that success, we can then take it to adjacent geographies which are closer to the Western markets. And with our distribution strength, our reach, village reach, and direct reach, etc., and that should help us. So therefore, we are very bullish on this acquisition because the level of headroom we have, not only in the big market size, but also the market share. Plus this market is 50% unbranded. So you can also convert a lot of consumers from unbranded to branded. That will give you immense benefits, in terms of market share gains. So it's we think it's a very good, deal in terms of the right strategic fit where we want to play. Now coming to your next question, why 51% and now why not 100%? A couple of answers. The discussions with the promoter family have been there for a couple of years. Somehow, what discussions came out was that in the best interest of the organization, best interest of the brand, it is imperative now that we both should continue for some period of time, because the capabilities, the learnings, the understandings which the current promoters have over last 2-3 decades, is phenomenal. We would want to leverage that, especially their knowledge in the formulations, their knowledge in and their understanding of the stockist system, the complete ecosystem in terms of stockist network, caterers, their relationships, their back-end facilities, their negotiation capabilities, and so on. And we think that once we start taking it to next level, to other geographies, their competencies will be really important to understand the taste preferences about the regional players. So we think it is important. And by the end of 5 years, then as per agreement, we would buy the remaining 49% to complete the complete acquisition.
Got it. Fair call. Well, one only hopes that some of these trends turn the corner sooner rather than later, Ankush. But thank you so much for throwing light on a number of factors around the quarterly numbers. Much appreciate your time, and wish you a great Q3.
Thank you so much, Neeraj. Pleasure connecting.
Likewise, and viewers, thanks for tuning in.
Thanks. Bye.